Welcome to the podcast that will teach you how to successfully invest in and build steady streams of passive income from the highly lucrative niche of mobile home park investing. Veteran real estate investors Kevin Bupp and Charles Dehart from Mobile Home Park Academy will personally share with you the valuable lessons they've learned along their journey as mobile home park investors, so that you too can learn how to build massive cash flow and huge profits from this extremely lucrative niche. So without further ado, let's welcome your hosts for today's show, Kevin Bupp and Charles Dehart.
Welcome, guys and gals, to the Mobile Home Park Academy's weekly podcast, where we'll provide all the information that you need to know to successfully locate, negotiate, close on, and make huge profits from the lucrative niche of mobile home park investing. I'm your host, Kevin Bupp, and today's show is part of an ongoing webinar series that my team and I have been hosting, where we invite a rotating panel of manufactured housing industry experts to discuss the state of our industry as it relates to not just the corona pandemic, but also the general outlook of the manufactured housing space and how you can not only survive, but ultimately thrive no matter what the current state of affairs are in our country. Now, in this webinar, we are joined by Kolman Bubis, who is a top broker with Sunstone Real Estate Capital Advisors, and Brandon Turner, who is the founder of Open Door Capital. So, guys, I'm very excited to get onto the show, but before we do, I have a few quick housekeeping items I'd like to run through. Now, to get signed up for our next event, which we'll be hosting in a few weeks, please use the registration link provided in the show notes. Moving on here, I want to remind you of the free gift that we offer to all listeners who take the time to leave a 5-star rating and review on iTunes. And what that is we'll give you the exact cold call script that we use in our very own mobile home park business. And we've purchased about half of our portfolio today as a result of our cold calling efforts. And so if you guys are serious about getting started or taking your business to the next level, then you really need to be cold calling mobile home park owners directly. And this script will help put you on your path to success. Now, to redeem your free gift, simply send an email to gift@mobilehomeparkacademy.com and just tell us who you are and what screen name you use to leave your review. And we'll go ahead and get that sent out to you. And lastly, guys, before we get rolling here into the town hall webinar, just want to make mention of a new program that we just launched, which is our new partnership program that's called Bring Kevin a Deal. And this is where I will pay you as much as $200,000 for any one deal that is referred to me that I end up buying. Again, up to $200,000 for any one deal that is referred to me that I end up purchasing. Now, to learn more about this opportunity and to also download my deal acquisition criteria guide, you can go to bringkevinadeal.com. Again, that's bringkevinadeal.com. And so, guys, without further ado, let's get on to the show.
All right. Hello, fellow investors, and welcome to another Mobile Home Park Town Hall. We thank you for joining us. I'm your host, Brian Spear, along with my co-host and business partner, Kevin Bupp. Kev, how you doing today, bud?
Doing awesome, buddy. Excited to be here.
Yeah, I share the sentiment. It's a beautiful, beautiful day, and we have a couple of great guests. I should say a few great guests to provide some high quality answers to your questions and give you an update on the current trends in the industry in our little niche. But with that, we'll jump right into it. I'd like to start with a brief introduction from our guest panelists. First, we've got the Beard himself, Beardy Brandon Turner, as well as his right-hand man, Ryan Murdoch. In addition to that, we have Kolman Bubis, all folks who've been in the industry for some time now. So if you guys could each give us a little bit of a brief intro, maybe 1 to 2 minutes on yourself, and then we'll head right into questions from the audience. First, I'll pass the mic to Brandon, if you would be so kind. A couple of minutes on yourself, bud.
Sure. Yeah. My name is Brandon Turner. I am a, real estate investor, and I like to surf. And so I live in Hawaii, and I made Ryan Murdoch live in Hawaii near me so he can carry my surfboard.
Just my arm.
And we buy mobile home parks. So we run Open Door Capital, and we buy a bunch of mobile home parks because I listened to a whole lot of Kevin Bupp telling me to buy mobile home parks. So I did. And, it's been going good. It's been exciting. It's been fun. And Ryan, makes me look good because I just, I smile and talk on a camera a lot. And then Ryan kind of helps us buy a bunch of deals. So that's kind of where we ended up working together.
So cool. So Kevin, I guess I can thank you indirectly for me ending up in Maui. So
Good deal.
My name is Ryan Murdoch. I'm the VP of Acquisitions for Brandon Turner's Open Door Capital. I've got a dozen or so years of multifamily investing and property management experience, and have been here in Maui for about 1.5 years, pushing 2 years, working exclusively on Open Door Capital.
Love every bit of that, guys. Very much appreciated, and thanks for jumping on with us. It'll be a fun call today. In addition, Kolman, I'd love to pass you the mic. If you can give us a little overview of yourself, it'd be great.
Yeah, I appreciate you guys having me on. I'm Kolman Bubis. I'm one of the founding partners at Sunstone Real Estate Advisors. We are a bunch of ex-Marcus and CV guys that started our own boutique firm about a decade ago. We only focus on MHC asset classes, predominantly disposition work, everyone from one-off owners to some of the larger operators. We've done about $1.5 billion of MHC dispositions over that last decade, and super stoked to see that I am not the only guy in a t-shirt right now.
It is Casual Tuesday here on the Mobile Home Park Investing Podcast, so it's a beautiful thing. Sometimes you have to live and breathe, kind of alongside of our group of residents. So in any event, all bueno.
There you go.
With that, guys, we've had a ton of feedback over the last couple months that we've been rolling out these webinars and talking shop with our group of listeners here, and the tribe has provided some feedback on kind of what they'd like to hear us discuss. We've brought on a ton of phenomenal guys that are in the industry, but one of the things that we have consistently heard back is that they would like to learn how to continue to grow, how to continue to scale in the industry. We have a large contingent of folks in this space that listen to us that have maybe 1 or 2 parks that are just getting started, all the way up to a reasonable sized portfolio, 10 to 15 parks. But how do you really get to the next level? How do you really scale in the mobile home park industry? So that'll kind of be the introduction on the call today. I would love to have a little open conversation around what you guys have seen. What are some of the tactics that you have implemented in order to actually scale inside of the industry at a reasonable clip? Kolman, you've been doing this for literally 15, 20 years now in this space, something like that. I don't want to speak out of turn here, but you've interacted with so many folks, and you have a broad swath of knowledge from the brokerage side, the finance side, and also the operations side. Prior to jumping on this call, I did not know that you actually own mobile home parks. For those that are listening in audio, I see some of the trim strips of a mobile home behind Kolman, because he's currently inside of one of the mobile home parks that he owns right now in Indiana, doing a little work. So I love that. He's got a ton of experience in a lot of different areas. But given that, could you walk through some of the things that you've seen successful operators do to actually scale? What are some of the keys that you've seen, Kolman, to get folks up to a reasonable scale?
Well, I guess the most basic one is deals. And I think, these days there's a lot of interest in space from, both people that are entrenched as well as people coming in from other asset classes. The word is out that, this is a business that can be very successful for both our customers and for our owner operators. And I think maybe that's the biggest beauty, is that it's amazing to see, new blood coming in and investing capital into assets that we can create a win-win for ourselves and for our customers. So the most basic thing is deals. And even when I'm talking to, our seller clients, we predominantly do seller representation, just because there's more buyers than there is product. I mean, the biggest problem with the MHC asset class is, at this point, there's really a finite amount of communities, and the good ones, you tend to see people hold on for long periods of time. I mean, I can't tell you how many owners I've seen that own their communities for 10, 15, 20, 30, 50 years. And that's a phenomenal thing, that, one family could grow a significant amount of net worth from owning one mobile home park and paying it off and operating it. So I always tell my seller clients, my other clients, like, I'm not the only guy that's going to sell you deals. So you need to really get out there, hit the pavement, look at your markets where you want to be, look at the markets where you are, and really start to, entrench yourself in them, wear some tread off the shoes, get out into the market, see the market, see the real estate, and start to network with other owners, network with the other brokers. I mean, we certainly think that our team at Sunstone is the best team of brokers for disposition, but there's a lot of other, great competitors in the industry that are doing a lot of deals. So I think just on the deal front, really put yourself out there and network with all the active brokerage teams, but also, look at the local brokers, look at the owners, look at the markets, and figure out really where you want to be. Because depending on what your goal is in scaling, it's hard to compete on the really big deals these days with private equity and pension funds and other types of sources. So as much as we all love to own, the brochure 55 plus on the beach in Malibu, that's probably not realistic for, most of the people listening on this call. So you got to get into some areas where you either can buy small and it's close to your home so you can get there and operate it, or if it's going to be farther away from you, I don't know of any mobile home parks out in Hawaii, although if you guys find one, I would like to buy a home. So really start to, think about like what's realistically the size of the deals that you want. And where I've had success is like, I'm an active broker. I can't, really be out there bidding on, big openly marketed deals. So I try to find some small deals where I could put a 30 unit together with a 40 unit and a 50 unit, and then it starts to run like a 100 unit park with some efficiencies. So that's, I guess, the first comment on deals. And then for the people that are a little bit more entrenched, I can't tell you how many people I've seen like spend time on the front end if you want to scale investing in your structure. And that's everything from really putting together your entities and your structures on the front end to how you're managing your assets. And it was pretty cool the other day on one of the mobile home park, groups on Facebook. We were talking about, buying deals is the fun part of this business. And at some point, running them is not as easy as it looks. There's a lot of blocking and tackling. There's a lot of crossing the T's and dotting the I's, and it really is a labor of love, and it's tough. So spend time kind of getting your systems in place so that you can add on additional communities and scale. And we can go into more detail on that, but I think I've spewed enough. So I'd love to hear what some of the open door guys think as well. Or if there's any follow-up questions on what I...
Yeah, no, I think, Brandon, you might be on mute there, buddy. Go ahead and if you'd be so kind. Let's see if we can unmute you. Nothing? Oh, gosh. There you go. Nailed it.
Okay, there we go. Good. All right. Yeah, it said host has to unmute. Good. Okay. All right. You want to repeat that question? I want to make sure I'm hitting exactly what you wanted.
So just some thoughts and ideas on how to go about efficiently scaling in this space. For folks that might have one or two parks all the way up to maybe a group of 10 to 15, how do you really get to the next level? How do you really scale in the industry?
Yeah. So a lot of people know that I'm heavily involved with Bigger Pockets, right? So I'm a minority, small part owner of them. I do their podcast. I'm involved, right? So Bigger Pockets a couple years ago brought in some partners, some private equity partners, and Josh Dorkin, the founder, took some cash off the table, kind of stepped back. And in that process, we met this new private equity team. I'd never met one before. And so I went and we went to Omaha where they're based, and I met with them, and we're sitting around the table, and we kept telling about all these ideas we had. And I'm going somewhere with the story. So I had all these ideas that we had for the business, and we're like, well, we can do this, and we've got 7 developers. We can do this, and we got this person on email. They can do this. And the guy was just like, okay, guys, stop telling me what you have and what you can do with what you have. Tell me what's possible. Tell me what you want, and then we can talk about how to get you what you need. And it was like this mind-blowing thing. I never thought of it. See, I'm very much like, here's what resources I have. What can I do with that? And they were coming at it from a different standpoint. That moment changed my entire life, because what I realized was I could define where I wanted to be. What level do I want to get to in a business of any kind? Then back in from that to the team needed and the resources needed to do that. So that's exactly what I did. I read a book called The Vivid Vision by Cameron Herold. It's a fantastic book. And I was like, you know what? I think it'd be fun to own 1,000 pads. We should own 1,000 pads, and in the next 3 years. And what would I need to do that? I'd probably need like a person that just does acquisitions. That's really good at that. I'd probably need somebody who's really good at investor relations. I'm going to have to raise money. I'm going to need, somebody to, manage the assets. So I basically worked backwards and came up with a team of 5 people that I would need. I need a personal assistant to help with this. Like, what would I need to build? And then within 6 months, we built that exact team. And that was the most crazy experience, because we went through a couple people. Some people worked out, some people didn't. But now we have this team of 5 or 6 people of just rock stars who are perfectly. It's like the whole Jim Collins, get them on the bus and get them in the right seat on the bus kind of analogy. Is we have the right people now in the right seats on the bus, and we know exactly where we're headed. And so what was our 3-year goal, we should hit here in the next couple months. Just a year in. Just because we have all of a sudden everyone there. So that's the biggest lesson I think in scaling is don't think, what do I have today and how can I use this to get there? Think, what would be required to get to the level that I want? Because it's all just mindset more than anything. And so then we just work backwards from there. So that's what I did. And what's cool in commercial real estate is that things like acquisition fees or asset management fees or whatever, they kind of help pay for the infrastructure to be able to do all those things. So it's not like I have to come out of pocket with 5 full-time salaries to make this happen. And there's also partnerships you can bring in and other things. So that's the biggest lesson I've learned.
Yeah, and just a real quick follow up there, Brandon, if you would. I appreciate you sharing that. As far as assembling that dream team, talk to me about actually attracting, those who share the same core values and philosophy that you ultimately had and that you envisioned for this, Open Door Capital, the company that you were building. How'd you go about doing that?
Yeah, so on Maui, there's a beach called Little Beach. Anybody ever been to Little Beach? All right, so Little Beach is it's the best surfing on South Maui, so that's where we go to surf. We have a requirement that if you come to Maui, you have to go to Little Beach with us. Now, it's also the clothing optional beach on Maui, and so we do not participate. But yesterday we were there, and we take all new team members there. I'm just kidding, we don't take them there. But yesterday we legitimately were there, and there's a man with an electric guitar on the beach, amp and all. That's it. Guitar and amp, and that was it. Playing music while we were surfing. So the reality of it, though, is that there's a cultural fit here that I value higher than skill set. Mm-hmm. So Ryan had never bought a mobile home park before we bought our first one together. I had never bought one, obviously, before I bought my first one. We have people that are experienced on the team, but what's more important to me is cultural fit, meaning I like working with these people. They're also super competent in every skill, but they didn't have to have experience. So anyway, that was a big part of the culture thing about building the team was how do we attract the right kind of culture? And so even as part of my vision of where we're headed, we just spec'd out what type of culture we want to have. We want people who are required to go out, required and go out and do something fun like surf or hike or swim or jog or something multiple times a week. Cause we want to know that that's just a lifestyle we have. We want to travel together. We want to have kind of do life together. And so we put that out there as that's the vision we're building. And it attracted people who liked that. And then of those people, we had 700 people apply for our last position. Now, granted, I have a huge platform to advertise open positions, but out of those 700 people, we would have whittled down to one person who was perfect in terms of, skill set and perfect in terms of culture. And so that's how we kind of built this, is from a culture foundation into skill set, but not necessarily experience in the mobile home park space. So that's how we did it.
Yeah, I love every bit of that. The hard skills are certainly important. You need folks that have experience who understand what needs to be done. But I agree. We agree as a team. We have had the most success hiring people that share our core values and filtering every decision on the hiring side through that filter first, and assuming they check the box on the core value side, ensuring that they have the hard skills. And even if they don't have all the hard skills, some of that can be taught, right? Not everything can be taught, but some of that can be taught. And I'd rather have somebody that has a perfect core value fit that will be willing to work with us in the trenches and get through whatever inevitable struggles and whatever inevitable glass ceilings arise as you go to the next level of scaling your business. It's going to occur, and you want people who are willing to work with you through those struggles. Additional little context that I would point towards on how to go about successfully scaling, and specifically in this industry. I would say that my little golden nugget, if I'm going to toss one out there, would be to view this not as an investment, but rather a business. I think the people that are really successful in this industry don't view this as an investment, but they come to it with a mindset of, I need to build the infrastructure, as Brandon had alluded to allow me to successfully operate this as a business. And I emphasize that in this niche specifically because in a lot of other industries, even if you do view it from a 10,000-foot view as a business, you largely have the ability to simply allocate capital in multifamily and outsource and hire an unbelievably phenomenal third-party property management company to do that operational aspect. And in most real estate investments, you need three things. You need to find the money, you need to find the deal, and you need to manage the deal. We've already talked about the first two. Coleman, you got to build your deal flow. I agree. You need to secondarily find the capital, as Brandon had alluded to. But operationally, how are you going to manage the deals? Because managing 30 spaces or 100 spaces is significantly different than managing 1,500 spaces, which is significantly different than managing 10,000. So whatever your goal is, whatever you're intending to do, work backwards from that and build out a full throttle, legitimate infrastructure for a property management company, a business, as opposed to viewing this solely as an investment, because it's not. There's moving parts here that you have to juggle in our industry. So
that's a great point. The human capital required for operating these assets well is probably more in line with a hotel than, in some regards, than a self-storage facility. one or two people can operate a 400 unit self-storage facility pretty well. The human capital requirements for MHC to do it well is huge. So I love the comments from both of you guys.
Yeah, love every bit of that. And then, in addition, right, adding to how successful MHP operators scale, it is all about the systems and processes. So in all three phases of that stool that was just referenced, you have to have some systems and processes to help you get yourself out of the weeds and delegate those tasks to somebody else. You can run a little small one-man operation to a certain level, but if you want to scale, you need to remove yourself from those positions. So, adhering to the business philosophy of all the great, business books that are out there, Good to Great, Jim Collins was already brought up. And I mean, I could list off 100 of them that you guys have already heard on 75 million podcasts. But truthfully, adding those systems and processes are unbelievably important. Just adding one example here, on the actual operational side of the business, we sat down and spent a little bit of time finding out exactly what we wanted the entrance of any of our mobile home parks to look like. It's the first impression of any prospect who drives into our community, and we want that to be stellar. So what we did was we went out and we vetted some of the larger players in the industry. What are the best folks in the industry doing, and want to mimic those respective best practices. RHP is the largest private operator of mobile home parks in the country. They're actually larger than one of the publicly traded companies. And I think that they have an unbelievably exceptional entrance to their respective communities. Immediately when you go into an RHP community that it's an RHP community. And it doesn't even have to say RHP. It's branded for that individual mobile home park, but by virtue of their branding at the outset who owns that. And we've basically mimicked something very similar. That is a system that can be repeatable. We call it the day one branding package, right? We've got the welcome sign, the move in ready signs. If there's a mile entrance on the road leading up to the mobile home park, there's a bunch of little signs on the far right side leading up to that getting there. It's kind of a move in ready, welcome, homes for sale, and whatever your core competency is in that community, whatever your value add proposition might be, we highlight that as well. If it's great schools, then that sign says great schools, or whatever it might be. In addition, directional signs, leasing office signs, and a little post for folks to park exactly where we want them to park, naming it future resident parking. I mean, those are small little things that we think through and systemize, make all those decisions one time. And then from that point, when you buy a new park, go ahead and order them for the new park and move on to the next phase of the business. And you don't have to think about it again. That part of the business is systemized. We move on to the next phase of the operational aspect of what we're doing. So again, just continuing to build systems and processes that afford you the opportunity to get out of the weeds of everyday management of the parks. Moving on to the next question here, guys. This really, I think, would be interesting to hear Kolman's perspective. Do you get better deals as a bigger operator? As you get bigger, do you actually get better deals?
I think from a brokerage standpoint, every deal has a different buyer. And I guess what I would say is, as you perform, right, people get more comfortable that you can continue to perform, or that you performed in the past, so that that's replicatable, much like your systems you're talking about. And funny you mentioned RHP, because they do have great signage. And I've actually talked with the guys at RHP about that. And a lot of those ideas they researched came from actually more of a struggling industry right now, which was more retail shopping. They wanted stuff that drew attention to the entrances of the community. So that was not by mistake. They spent a lot of time into that. And I think it goes with, with buying, like if, in full disclosure, right, if you have a buyer that doesn't own any communities, even if they have capital, and you've got someone else who, is an owner, it just gets easier to feel comfortable that you're going to be able to work through issues that arise in any transaction with people that have been there before, and frankly, maybe even you've been in the trenches with. So we've seen situations where sellers have elected to take, a slightly lower price, right? And no seller in the right mind is going to leave $1 million on the table to go with another buyer. But we have seen situations where, buyers who have a track record of performing in the space have gotten slightly better deals because the seller felt comfortable that they had seen the property in the front end, they understood the asset, they understood what they were buying, and the issues that would create a potential renegotiation were vetted on the front end, and or they put up aggressive terms with short diligence periods, large earnest money deposits, going hard on large earnest money deposits quickly. So I do think that it can create some situations where you can do a little bit better, but anytime you can add another notch to the track record belt, that definitely can help you with getting some off-market deals too, where you're first at the table and you get the seller comfortable with you. It is a little bit harder in full disclosure when it gets to a broker like us or one of our other very competent competitors, just because we've seen the process play out. But I absolutely think that as you get better systems and better scale, that you can put yourself ahead as a buyer for future deals.
Yeah, we've seen that firsthand as buyers, and it's kind of an interesting progression over the past couple of years, where everybody on the team has a decade plus of real estate investing experience, but Open Door Capital in its current form is fairly young. I mean, less than 2 years old. And when we started this, it was kind of a push to, we're doing those kind of icebreaker calls to brokers and introducing ourselves and trying to get people to take us seriously. And now that we've closed several deals, we just had a broker that had another deal under contract with a different buyer. It fell out of contract, and instead of relisting, he turned around, brought it right to us, because at this point he knows we've done a deal or two with him already. He knows we can close. He knows that there's a small likelihood we're going to try and retrade once we agree to it. So just watching that track record of ours and the sort of the reputation that we're building has certainly gotten us attention from other brokers. So we've no doubt landed deals that way that we wouldn't have been able to land a couple of years ago because we were too new.
Yeah, no, that's great feedback. And, Kolman, this is more pointed towards you, and it's a follow-up question. It's, for those that are brand new to the business or just kind of getting their feet wet, maybe they've got a park, but fairly new to the business. Are there any other items that you would suggest that they include, when making an offer, reaching out to you, such as like, a pitch deck, a general overview of who they are, their background, their experience, proof of funds? I mean, a general, investment package. Does that help the cause? For those that are new to the business?
I mean, I think with anything, whether it's selecting a buyer or even buying the community, right? The more boxes that you can check in terms of diligence you've done on the front end and or answering questions, the more risk you're taking away from the transaction, and the higher probability that things go as planned, I would say is great. I mean, I think the most simple one that we love to see is people getting out and seeing the real estate, because it's harder to take someone seriously, whether it's a $500,000 deal or a $50 million deal, if they haven't, and I'll fully admit, in a post-COVID world, it's a little bit more onerous to get on airplanes, but sending your manager, sending someone else from your regional team, those are things that just get you warm and fuzzy that you've seen the asset. And frankly, as a buyer, right, that can put you in a better position. Frankly, maybe you're willing to pay a little bit more because you see how good the area is, or you see how under market the rents are, and that little bit, that extra work that you did and time you took to really learn the opportunity gets you more comfortable that you can pay more. So yeah, proof of funds are phenomenal. Any letter from your bank, anything else, just to know who you are and that you've got the capabilities to do what you are saying that you can do, helps to make us feel better. And at the end of the day, the seller, because they're the real decision maker, but they're using us as a bit of a sort of a greeter, so to say, to interview that process and search it out. So yeah, all those things are phenomenal, and just help everyone get more comfortable that we're negotiating in good faith and moving together as a team, because we do represent sellers, but at the same time, brokers are really intermediaries of getting two parties to that have opposite objectives to a place that works for everyone. And deals still have to work for everyone, or you don't have a transaction. So anything you can do to make yourself stand out, I think is great.
Great.
Yeah, love every bit of that, and couldn't agree more. I was going to follow up with this, right? One of the things is, how do you, to your point, how do you wish folks would reach out? You just walked through that. What is the worst way that somebody could reach out to you? What immediately gets that outreach thrown in the trash can? Somebody who's trying to grab your attention, trying to get a pocket listing, trying to build a relationship with Kolman. What makes you go, I immediately delete this email, or whatever the case may be, so that folks can avoid that as they progress?
Yeah, no, I think, just, at the end of the day, like, if you're really serious about a deal, like, we're happy to get on the phone with you to go through it. We really like when, I'm getting a ton of emails per day. So I really like, if you have questions, let's put them into one document. Because I also don't want, sometimes I'll forget to respond because I get busy or miss an email. So I love when people, actively engage on looking at the real estate and ask a lot of questions, but versus maybe piecemealing one email with one question or calling me and I'm in the car driving. It's great when you can organize those questions, because I also, drop the ball sometimes and want to make sure I'm responding to your questions. And then just, starting to familiarize yourself with the landscape of the market. I've been brokering now for 15 years, and I can honestly say that I've never seen more interest in the asset class. And that's awesome because we're getting new, smarter people in, and frankly, like, we're still seeing a lot of negative PR with people not operating their communities well, in trouble with the city for not maintaining things. So the more positive attention we can get to our space, the better. So I love meeting new people and frankly hearing about smart people from other industries coming into our industry, because they can bring some best practices or maybe some new ideas that we're not thinking about that can help improve our systems and or our properties for our customers and frankly our returns for our investors, all the above. So I love meeting with people, talking with people. I don't mind if you call my cell phone, reach out by email, but I always try to be respectful of people's time as well, and be organized with your approach as well, so that we get a good feeling that you're looking at the deal and you're doing your best to try to wrap your arms around it. And we're certainly, if we're in the middle, going to ask you to stretch on price a little bit because it is competitive. So anything you can do to help us feel comfortable with you is great. And again, COVID, but I love getting together with people in person. Real estate, we're not buying bonds, we're not buying stocks. I love walking the communities and really meeting people in person. So then you start to understand their personalities too, because personalities do come into who you like to do business with, who you want to do business with. And, the in-person aspect of real estate is important. And especially the younger millennial generation, we're so used to email and touching people electronically that, I've gotten a lot of listings by getting on a plane and go meeting the seller and seeing the park. And I hope other brokers aren't listening to this, but that's a big thing, I think, in real estate still.
Yeah, love every bit of that. As more and more folks come into the industry, a rising tide will lift all boats. Cap rates have compressed significantly. We've seen this over this massive trend over the last several years, and ultimately there is a runway where the assets that are owned by those legacy families eventually will get swallowed up by aggregators of portfolios, and this industry will continue to go down their next phase of consolidation. One question that I had for Kolman is this, right? You mentioned, hey, some of these guys own it for 30, 40, 50 years, but when you transact a park, have you ever brokered the same park twice? And the follow-up is, how much turnover typically is there in park ownership? Like, what was the average duration of the hold period, do you think?
I would say not only have we brokered the same park twice, I think we've got a couple that we've actually sold 3 times at this point. I know Waylon's got a few, my partner in Dallas, some assets in Metro Dallas, since he's been in that market for so long that he's at this point transacted 3 times. And everyone's got their reason for selling and their timing for selling. We've sold assets once and then we sold it for the bank the next time, and then someone else added some value and moved on. People have their different reasons for selling. Just because someone's reselling it or we've sold it before doesn't mean it's a bad deal. It just means, maybe someone got in over their head operationally. And that's, what I'm starting to see, at least from some people that have entered over the last several years, is they underestimated the operational challenges and, are having some learning curve in that regard. But there's several assets at this point that I've transacted 3 times. Beautiful. I don't think I've gotten any to 4 yet, but a few assets that I've sold 3 times at this point.
Yeah, I love that. It just tells me that consolidation phase is certainly encroaching. It's approaching. It's certainly closer. I mean, that's much, much, much more commonplace in some of the other asset classes that are much more institutional, et cetera. So I love every bit of that. That's phenomenal feedback. Question for the BP clan over there. What has been your biggest takeaway from running syndications and or funds thus far?
Good question. I don't know. What do you think? I guess I'll go with this one, and you can see if you agree. I think raising money has been easier than I expected. Where I used to say I'd never want to raise money. I hate raising money. I don't like asking for money. I just felt really weird about it for a decade, and I just never did it. I just ever did everything myself, or maybe brought in a partner. Because I was so terrified. I once asked 2 friends of mine if they would invest in a deal. I had one small deal I wanted to do. It was like 3.5 years ago, and they both turned me down. It just crushed me.
I was one of those guys.
But I guess so. I was just terrified of it, and it was what I realized today. It was more of a mental hurdle than anything. It's just like I had this self-limiting belief that I couldn't raise money and that was going to be hard. And then I actually went and did it. And again, I know I have some advantages being on the podcast and having a big Instagram following. But I guess I play to that strength, as that's what my strength is being the outward facing guy. And I'm good at, building an audience. And so it was easier than I expected. What has surprised me is how many people are excited about it and then never wire their money, where they fill out all the paperwork. And we've had a lot. I mean, and I think it's just because we haven't given them a hard deadline yet. It's not like, hey, we're closing Friday, you got to do this, because we're doing a fund, not a syndication, right? So if we don't have quite as much of you need to put your money in today, which we are going to close our fund shortly for that very reason, because we're we got to get more people they're excited to do it, just nobody wants to be the first one in. They all want to be wait until the end. So there's a couple of notes I've thought.
Yeah, and I think you're probably a lot more confident too in asking for money, because you've got a good team behind you that backs you up. So if you're by yourself trying to raise money, you may be able to raise money, and then you're like, holy smokes, what am I going to do with all this money? I can't watch over this, which you certainly are capable. But with the team that we have in place now, that money is in good hands, and that we've got a pretty solid track record of what we bought and how we're operating. That I think it just that flows through in your requests and your outreach to raise money. You can invest with confidence. I'm confident in asking you for this money and presenting this opportunity to you, and we're off to the races.
Yeah, I love that. I mean, you have to have a track record, right? I mean, I share the sentiment about how that could have been a little bit more of a hurdle at the outset. Nobody wants to invest and have their capital at risk while the other side of the table learns on their dime. So now that you guys have been doing it for a period of time, I mean, the track record continues to improve, and we've shared that same sort of trajectory on our business, right? Kevin bought his first mobile home park in the early 2010s, and we didn't start our first fund until 2017. So, we've been doing it for a decade, but it took a while to build the track record. Deal flow continued to increase. We had many more folks reaching out, looking to allocate capital to the space. Became prudent to move forward in the fund structure at that point. But I mean, nobody's going to be able to. I mean, some folks may be able to, based on their historical experience in different asset classes, et cetera, be able to start a fund from scratch. But it certainly helps to have a proven track record when launching that fund. Kev, any feedback on takeaways here?
Yeah, just had another question, a little follow-up question there for Brandon and Ryan. As far as the fund structure and building a portfolio, have there been any unexpected challenges that you guys have faced that as you grow the business, as you acquire multiple assets in different geographical regions, what have you? Are there any challenges that you face that weren't really planned for in the front end? If so, what were they, and how'd you overcome them?
Yeah, a couple things come to mind. I mean, one, it was early on. So I'm a big believer in aligning interest, right? I want pretty much everyone on the team to either have or have an opportunity to earn equity in the GP and in the funds, and so I want everyone aligned together. In the beginning, trying to work through splits of the GP early on before we knew what we were doing ended up being just a nightmare. I mean, just we brought in partners and we gave them mass amounts of equity, and then they didn't work out, and then it's a really awkward situation of what do you do now, because they're not really part of it anymore, and they still own a lot of the company. We offered some equity for people just in our network. I'm a big believer of getting other people, and this again goes to my position with having a large, Instagram following, but getting other people out there to find deals for us or to find opportunities. And so we gave some GP to other people. And so like one of the deals is somebody passed over from a broker, and we hadn't it was like 5 minutes of work, and now they own a sizable chunk of that park because of 5 minutes of work. And I'm like, that was a big lesson learned. Like if we're going to offer, large equity, I guess just the way equity works, because there's no standard. It's not like I can go look in the book and like, this is what everyone does. Like everyone's so unique in how they structure their team members and who gets what. So that was probably the biggest challenge. Yeah. Getting started, just trying to figure out who gets what, how do you earn it? How do you not earn it? How do you incentivize people without me losing all my equity in my own company? Like, how do you do that? Yeah. So that's been a 2-year process, but I feel like we're at a good spot now, but that'll continue to evolve as we build more and more team members. Like, how do you do it?
Yeah, and I would say that one of our biggest ongoing challenges is although we've been able to successfully buy deals that we're happy with, we've had to pass over a lot of what I consider good deals, but they just didn't fit the returns that were promoted within our fund. So Kolman, you made a point that, there's a different buyer for every deal. So we've had deals come to us that people just knew were right, because we tend to promote pretty heavy cash flow right out of the gate, which is tough on a big infill project because that may require, 24 to 36 months of no cash flow. It just doesn't fit in our box. So we can't take it. But if we do come across a deal like that, we try to find out who else is out there and what they're buying. So we can turn around, maybe pass that deal off to somebody else, either for a fee or just for some goodwill and just to get out there. And we've had deals come to us that didn't fit other buyers' requirements, but they brought it to us and they said, yeah, this is definitely an open door capital deal. Here you go. So it is as fun as it has been and it allowed us to grow. There are some constraints where like, man, that's a great deal, but it just doesn't fit. So we're exploring, maybe different funds, maybe running a couple simultaneous funds with different promoted returns to try to capture more of those types of deals that we currently have to pass on.
Look, I think that is exceptional insight from both of you guys, and we share the sentiment, right? We've run through very similar structures in the past and similar issues as we've grown. So I love the insights from Brandon regarding the GP equity piece. That's always a difficult piece, right? And it's something that the LPs typically don't see on the back end, but it is unbelievably complicated to figure out exactly how we should handle this for our team to incentivize everybody. We share the sentiment. We've run into those same issues historically, and have learned the term vestiture over time to ensure that folks are compensated appropriately for the work that they put in over time for the organization. So that's something that everybody can take away here, ensuring that their interest vests over a period of time, given the amount of work that they put into the deal. Folks need to be compensated accordingly, but we'll leave it be at that. It's difficult to carve it out, but vestiture is a prudent way to help you align interests with all parties.
Yeah, smart.
Heading on to the next piece here. This is regarding private utilities. And everybody can kind of talk to this one, but Kolman specifically here, what are the buyers' appetites for parks with private utilities in today's marketplace?
I think, the reality is getting smart on private utilities can open some deals that are great deals that, created a little bit of added risk that, you can get smart on. The reality is that half the country drinks well water, whether they're in a mobile home park or in a single family home. And a lot of places in the country, have different forms of septic systems. So I've seen a few very smart guys in the industry. We've done a good amount of business with Stone Capital out of Colorado, and they, were very smart to get smart on different systems of private utilities and figure out what they could live with and what they couldn't, because it shouldn't just be a deal killer because a property has a well system. The reality is well systems, frankly, are actually cheaper to operate than buying water from the city. And you have control over your destiny, where if the city starts to raise water costs, that's dollars you're going to have to pass on to your residents. And you have some cap and risk. If your well goes out, that's probably I'm making numbers up here, a $50,000 problem, which, you can do diligence on the front end to account for those dollars. And, like I said, the dirty little secret is it's way cheaper to run a well than it is to actually buy water from the city. Does that create some added, challenges or opportunities, of course, but those are systems that you can get smart on. And the same side for sewer or master metered electric systems, where you got a utility company that has one meter into the park, and you're billing the residents back for electric just like you could for water and sewer. It gets a little bit more complicated on the sewage side, just because there's a lot of different systems. Septic from one tank per home to a sewer treatment facility that runs the entire park, or where if that fails, it could be $500,000 or $1 million capital project. But I have seen some very smart buyers in the industry get smart on private utilities, because a lot of people just frankly say, hey, I'm not going to touch an asset if it doesn't have municipal water and municipal sewer. And I think that's fine if that's your stance, but I do think that, there's some good properties on municipal water. I know of a mobile home park that traded in Metro Chicago that I could literally hit my pitching wedge from the park into the runway at O'Hare.
Oh, yeah.
And it happens to be on well water and a private sewer system. The lot rents of that community are $800, $750, $800 a month. Would you not buy that because it has well and septic? I think the answer is you got to get smart on those systems, or you just got to accept that, there's going to be people that are doing those deals who have gotten smart on those systems.
Yeah, there's a few phenomenal parks right by O'Hare. I mean, maybe 600, 700, 800 spaces right next to O'Hare, and just beautiful, beautiful real estate. Man, I'd love to own those puppies. But in any event, moving on here, I share the sentiment regarding private utilities. We've experienced the same exact thing. We've had some successful parks with public utilities. We've had some successful parks with private utilities. Just because I would not want to move away from an asset just because it has well and septic. We have a deal that we took down in 2017 for $2.65 million. 180 spaces that just refinanced at $6 million, and it's on well and septic. I'll take that. We'll learn about wells. We'll learn about septic. We'll learn how to go about operating that and put aside the reserves necessary to ensure that we can renovate those issues as they arise, rectify any respective CapEx that pops up. But I'm not going to walk away from that just because it's got a little hair on it. If we can solve those problems, if we can figure out those problems, there's a lot of sweat equity to be made there. So I share the sentiment.
One thing I teach on like Bigger Pockets webinars and stuff all the time is to encourage investors to stop thinking, is this a good deal? But start asking, what price makes this a good deal? So there's a price for everything. I mean, you could buy the worst mobile home park in the country if somebody paid you $10 million to buy it, right? So everything has a number. So we don't buy anything right now with the bad utilities, but we would if or not bad utilities, but I wouldn't buy anything with like a weird septic lagoon, like where they just have a drainage pipe into the neighbor's, swimming pool.
Yeah, unless there was a price that you
unless there was a price,
sewer,
make it work. So everything's got a price. So yeah, it's just that thinking of how versus yes or no. I think is just an important.
And we're finding the right expert to help you quantify that risk.
Yeah.
Yep. A great point. Pivoting the conversation back to scaling inside of the industry, there's a couple of different manners in which folks can scale. It can be done via volume by doing a litany of transactions at a very modest price point or size, number of pads, or doing their best to hunt for the whales that are significantly larger transactions, but doing a smaller number of them. So again, it's neither here nor there, but I mean, there are a couple of different paths to get to scale. A question that I'd pose here for Kolman, you've been in the industry for a long time. Assuming somebody wants to go for the deals of magnitude, what percentage of the transactions are currently above the $5 million price? And then what are above the $15 million price? We can run up a pretty reasonable portfolio if you're doing deals of that size. If you'd be so kind as to share a little insight there.
Yeah, so we took a look at our sales volume and spent some time on one massive spreadsheet that basically had every deal that we've ever closed. And that was from the $300,000 park to, right now we're working on a transaction that's, $250, $60 million range. So if you took all those and you average them out over the period of time that we're in the business, the average deal size came out to around $5 million. Which if you compare that to multifamily or senior housing is very small. But I think, it depends on, like, to Brandon's point, I love that, of like, where do you want to go? If your goal is to deploy, $200 million of equity in the space, that's very different than saying, hey, I'd like to keep it small where I can have control, and I would like to build up, 1,000 units in a reasonable manner over a period of time. So where you want to go, I think is the key, because then you got to work backwards. If you want to deploy a large amount of capital, we've seen some of the larger entrants into the space, the private equity funds of the world, the Apollos who purchased Inspire, right? So they paid up for an existing portfolio of assets, and they also paid up for a management platform. And Blackstone did the same with Treehouse. TPG did the same, which is now Strive. So if that's not on the level of deal, right, those portfolios are trading at low yields, but at the same point, to your point, those groups are also buying a business platform that they then can scale on, onesie, twosie deals that become ultra accretive. I mean, the beautiful part about this industry is that we see, significant cap rate premiums for larger deals, right? The sum of the parts is worth more than the individual pieces. Mm-hmm. So I think, figure out where you want to go and then back into it, right? If, like, for most of the people listening on the call, what I always tell them is, like, get into a market. If you're not there, get there, and then try to add on other pieces in that market to scale your operations. And then add on onesie, twosie, because if you do decide to sell, you sell that whole market, or you sell the entire portfolio together, and that's where you're going to see the biggest pop in value accretion. So I think the first question is, like, how big do you want to get realistically, and then backing into, like, what you want to buy. I've always looked at it and think, the guys that are out, hey, that buy a little portfolio and then add on onesie, twosie. If you exit that in a portfolio, the value creation is going to be huge, because there just aren't that many big deals happening. We've had one or two, billion-dollar deals a year in the industry. Most of the portfolios are under that. So that was always the precluder for larger funds getting in, is they wanted to write a big check now, and there just aren't that many of those opportunities because there's only a finite number of parks. I know of maybe 3 or 4 new construction communities coming out of the ground right now in the country. So you've got a static or diminishing stock. So you got to find ways to pick your spots to really, build scale.
Kolman, just to follow up on that, do you see some of these larger private equity groups and institutional buyers that are looking to write those really large checks, which is, again, incredibly difficult given the finite number of parks that exist? Do you see that some of those folks are now maybe expanding their horizons a little bit and maybe considering not just MH, but also maybe an RV MH or even an RV component, and placing that into the portfolio considerations? I
do. I think that, RV is getting a lot more looks because of the concentration of people interested in MH. Mm-hmm. And some RV parks, when you start to look and smell, they smell a lot like MH, especially park model communities, which I don't really understand why that's classified as an RV when it's built in the same assembly line as most HUD manufactured homes. So I do see people spilling over into that space and looking at RV as a different part of the portfolio that also can be great and produce nice yields. I mean, operationally, they exhibit some different challenges and or opportunities. Yields have historically been higher. But I do see more interest in RV these days, just as the running for MH has gotten tougher. Mm-hmm.
Yeah, I love that. Got some questions from the audience here. Nick, he says, I'm thinking about selling my 62-space park. Lot rent is under market by $30. Should I increase it now, or should I leave a little on the bone to increase interest and get the highest sale price? Kolman, thoughts, man?
My first question would be when your last rent increase was, but I think at the end of the day, buyers want to pay for what's in place today. So my suggestion would be, if you're trying to squeeze that last bit of toothpaste out of the tube, get to a point where those those rents are in place, because even the agency lenders now, you don't need 12 months of collections for them to count that rent increase. Once it's in place and it's seasoned for a month or two, people will start to buy off on that when it's being collected. So my advice would be get the increase in now, and we can still underwrite that on a forward-looking basis.
Yeah, I love that. And share the sentiment. The income stream is treated a little different depending upon if it's MH or RV. If it's MH, the agencies will immediately basically capitalize that. But if it's RV, they'll take a little bit more time to weather it to ensure that that recurring income stream is actually there in perpetuity. But love every bit of that. That's great stuff. What else we got here? Rick, how has due diligence been handled with park-owned home inspections with the pandemic, obviously, and inability to kind of get close to folks? I mean, typically we're going into homes and vetting them, et cetera, specifically park-owned homes. Are there any specific measures being put in place to address challenges associated with those interior inspections on those units? Thoughts, Ryan, Brandon, what are you guys doing on park-owned homes on the acquisition side when you're trying to underwrite these deals?
Well, with park-owned homes, my advice would be to inspect every single one of them interior. Do we do that? No. And we've been fortunate in, I guess, the timing that we haven't had a park that we had to do due diligence on with a significant number of park-owned homes during this COVID mess. I've got some trips planned next month for some due diligence, and there are some park-owned homes, and we will be going through a fairly significant sampling of those. And if we need to wear masks or other protective equipment, certainly all for that. I haven't had to do it yet, so limited experience with it.
Yeah, good feedback. Coleman, any thoughts here?
Yeah, no, I think the prudent people, especially if it makes up, a large piece of the transaction, prudent people are still, inspecting homes, random samplings. Here's a list of 40 homes. They pick 20 at random, notify residents. And, the one thing about COVID that as we're starting to get into it, I think people are realizing it doesn't spread as much through surfaces. It's more close contact. So the personal protective equipment, is key. And obviously getting that list to the seller early so we can notify residents, and hopefully they can be in the yard playing or not at home so that you can keep proper social distancing. But at the end of the day, especially with a community with a lot of chattel, be it notes or rental homes, that could be a significant piece of the puzzle. So you still have to do your proper diligence there.
I agree. It's an imperfect science. It's very difficult. Obviously, when we're in standard due diligence times, we're going into every home, we're vetting it accordingly. We likewise have not had to be in due diligence on park-owned homes to date. We are in the midst of a disposition where someone is needing to go through some of the park-owned home units, and I'm uncertain exactly how that is going to be handled from that buyer's perspective. But obviously, we're going to put the residents' interest first, follow all the requisite CDC guidelines that are in place, and ensure that the residents' safety is number one. I mean, that has to be taken as priority number one. But assuming we have the folks that are flexible on both sides there, would love the opportunity to vet every single home prior to going to closing. Because if you don't, there is a high likelihood that you will uncover some items that you may not you would not have been able to notice from the exterior of the home. So with that, guys, we've been on for right at an hour. I want to be mindful of everybody's time. So to that end, I'd like to say thanks so much. It's been a lot of fun, guys, for having you on. I sincerely appreciate you jumping on the show. Would love to give you guys a minute to just say, what is the best way for folks to reach out that are listening to you, that want to reach out, get to learn more about you, your company, and what it is that you do? Where can they find you? Pass the mic first to Coleman there.
Yeah, feel free to give me a call in the office. It's 312-568-4818, or you can email me. Is also great. Kolman with a K, O-L, no E, M-A-N @sunstonerea.com.
Love that.
And just wanted to say thanks for having me on. It was great, and appreciate it. And hopefully we can continue to rock on in what's a super awesome asset class, and look forward to getting out and seeing you guys in person, hopefully again soon here.
Yep. Share the sentiment. Brandon, go ahead, bud.
Yeah, you can find me down at Little Beach playing electric guitar with Frank. You can also follow me. I'm a big Instagrammer, so I'm like your classic millennial. I like Instagram. So you can follow me at Beardy Brandon, Beard with a Y. And then, of course, our website is opendoorcapitalllc.com or ODC Fund for short, or odcfund.com.
And you can email me directly, Ryan, RYAN, at odcfund.com.
All right,
if you email
guys.
me, I won't respond.
Well, it has been a pleasure, my friends. Life is good. Kolman, likewise, would love to jump on the course and hit a couple of balls with you at some point. Beardy Brandon, it's been a pleasure having you, bud. Your reputation precedes you. This has been a lot of fun. But with that, we'll take off. Until next time, you be great.
Thanks, guys.
Thanks, guys.
Appreciate it.
Congratulations for taking the necessary steps to achieving massive success through the highly lucrative niche of mobile home park investing. Be sure to visit our website, mobilehomeparkacademy.com, to download your free digital ebook version of the 21 biggest mistakes investors make when buying their first mobile home park and how you can avoid them. And while you're there, be sure to subscribe to our free monthly mobile home park investing newsletter, which is jammed full of valuable tips, tricks, and strategies to help you accelerate your path to success as a mobile home park investor. More information about this podcast and its hosts can be found by visiting mobilehomeparkacademy.com.